So glad you could join us today. So glad you could join us today for our webinar. I think probably we'll still have a few other participants dialing in, but we'll get started in the interest of time. So I'm Krista Clapp, for those of you that don't know me. I'm one of the co-founders of CICERO Shades of Green. And today we have a short but exciting program for you today. Just a housekeeping item up front, the webinar will be recorded and we can share the recording with you afterwards, and also for those that couldn't make it for time zone or other reasons. And we know that some of you have submitted questions and answers to us ahead of time. We've had a look at those. We'll try to incorporate those to the best of our ability, and those we can't answer right away, we will try to follow up with after the event. You're also welcome to submit questions and answers in the Zoom function for Q&A. And we won't have a session where we're taking live Q&A because we only have an hour with you today. But again, we can try to follow up after the event. So please feel free to use that Q&A box. So as many of you know, CICERO helped start the model for a second party opinion for that first check against greenwashing for the first labeled green bond in the market back in 2008. And setting up this model for an external review has continued and grown into what is best practice around the world today. So we're still one of the leaders in providing independent external reviews for green and sustainable bonds. And one of the distinguishing marks for us is that we focus on climate risk. We take a deeper dive on climate risk, which is in contrast to what you see as many of the ESG products on the market that wrap up a lot of other elements as well. So we're deeply focused on climate risk. And since the beginning of the market, we've had the opportunity to review over $380 billion worth of green and sustainable financing. So that's quite a lot of experience we've had. And each year we take the opportunity to reflect upon what's changed both in the climate science and market practices, consumer practices, technology developments, and what have been some of the interesting examples that we've seen in different sectors. And so this is our annual best practices report. We're happy to share the report with you after as well. We will cover some interesting elements today during this 1 hour webinar, but of course there are some sectors that we can't cover. And those we encourage you to either follow up with us or take a look at the report afterwards. We really hope it's a useful resource for you. We hope it helps you identify some interesting examples for potentially your clients in different sectors, or if you're a company thinking about issuing or updating your framework, perhaps this can also inspire you. Or maybe you're a company looking to align with the EU Taxonomy or to prepare for TCFD reporting. We also offer company climate risk assessments, and we'll talk a bit about that today. So for today's program, we're going to kick it off by having Dr. Glenn Peters join us from CICERO, our parent institution, a climate research institution. Glenn Peters is one of the most renowned climate scientists on mitigation and scenarios. And he's one of the research directors at CICERO, our parent institution. And we both had the pleasure of serving as lead authors for the IPCC climate report. That's the UN climate report on mitigation that came out last spring. After Glenn does his presentation on the latest in climate science, we're going to walk you through a couple elements of the report. And I'm so pleased you get to meet or see again some of the members of the CICERO Shades of Green team. We'll kick off with Catherine Rothacker, who was responsible for pulling together this fantastic report. She'll give an overview of what's contained in the report. And then we'll have Karina Vogue talking about how we assess EU taxonomy alignment with an example, followed by Christina Allness, who's going to talk about how we look at companies and equity products and do a climate risk assessment for that, followed by Dr. Keith Lee talking about SLBs today. And then we have Tim Axman following up with a focus on the energy sector and some examples. And lastly, but not least, we have Maria Mirvol, who will talk about the real estate sector and some great examples there. So we really hope you enjoy the program today. And with that, I'm going to turn it over to Glenn for his presentation.
Hello, everybody. It's great to join you. Are you seeing the right screen there? Do you see my presentation?
Yes, we do.
Yes, that's good. So I want to give you a quick rundown on the latest in climate scenarios, some of the stuff that's come out of the latest IPCC assessment report. And I'll also talk a little bit sort of background setting here is will there be a new normal? So when we go through a crisis like Corona and now with the Ukraine war, then we're always talking about something will change. There'll be a transformation into a new normal, but does it ever happen? So that will be a bit of a background thinking when I go through the presentation. So first of all, key message here, we're still heading in the wrong direction. This figure shows global fossil CO2 emissions over the last 120 years, steadily rising, as you see. And each of the green text blobs here is a different crisis of significant global significance. So in the middle, there's the two oil crises in the 70s and 80s, the collapse of the former Soviet in the early 90s. Moving up more recently, a decade ago now, the global financial crisis, where there was a big drop in emissions, economic activity, but also a lot of recovery packages afterwards, and we saw a huge spike in emissions the following year. Emissions sort of started to level out. We're maybe getting a little bit too excited if there was a peak in emissions, and then suddenly we had the COVID pandemic, a huge drop in emissions, about 5% down, and then straight back up, 5% up in 2021. So generally speaking, after each of these crises, we've responded strongly. And despite all these commitments about transitioning into something new, that doesn't at least come out as a clear signal in the emissions data. If we look at what's happening in 2022, our preliminary data suggests that emissions will grow again around about 1% in 2022. So, despite all the progress on climate, we'll still have record high emissions this year. Many of you would have heard of the carbon budget or the remaining carbon budget. The background here is that global warming is a cumulative problem. So the total warming is quite strongly linked to the total cumulative CO2 emissions that we've emitted over all time. We do make an adjustment for non-CO2 emissions in these calculations, things like methane and so on. So that's all considered here. And these three pie charts show the remaining carbon budget for different warming levels. So if you look at the first one, 1.5 degrees with a so-called 50% likelihood, we can emit in total around about a little bit less than 3,000 billion tons of CO2, 3 trillion tons of CO2. It sounds like a big number. In many senses, it is. We've already emitted about 2.5 billion tons of CO2, and we've got 420 billion tons to go, which is pretty small when you consider that we emit about 40 billion tons each year. So at the end of this year, this budget will be only 380. At the end of 2023, it'll probably be 320. And if emissions stay flat for the next decade, this budget will be completely gone. Even when you're reducing emissions, the budget is still getting smaller. So as long as emissions are continuing, the budget will diminish. A little bit of good news, I guess, out of this is looking at the other two pie charts there. We see that if we go from 1.5 to, let's say, 1.7 degrees, of course, we get more impacts, but the budget is quite a bit larger. The remaining budget is almost twice the size. And if you go up to 2 degrees, of course, more climate impacts, but the remaining budget is about 3 times as much. So even if we miss 1.5 degrees, if it's too small a budget for us to get into, then the higher warming levels have quite a big step in the size of the budgets. When you have a budget, you often think in the sense that the pathway doesn't matter so much, it's the total that you emit that matters most. But when we're so close to the target, the pathway starts to matter, particularly for this sort of cumulative problem. So in this figure here, global total emissions, so including land use change, if we take a straight line down to zero using the budget that you saw in the previous figure, so 420 billion tons is the grey area of the grey triangle there, we get to zero in around about 2042, 2043. If you get to zero in 2050, which is what you hear a lot about in the IPCC, that's an additional 150 billion tons. Why is that bigger than the budget? Why don't we say you need to get to net zero in 2040, let's say, instead of 2050? The reason is that most of the IPCC scenarios actually go over 1.5 degrees. They can't get down fast enough, so they exceed 1.5, go up to about 1.6 and then come down. And this is why the net zero is happening in around about 2050. If you look at the red line there, this is what happens if you delay. For example, if emissions stay flat out to 2030 and then you decide to get your act together and get to zero in 2050, then you still would have emitted a lot more carbon, and that would be around about 0.2 degrees higher. So delay is costly when you have a cumulative problem. This figure here shows the 1.5 degree scenarios that came out of the recent IPCC reports. There's about 100 scenarios consistent with keeping below 1.5 degrees at the end of the century. You have these little overshoots in temperature and then come back down towards the end of the century. You see there's some variation there. Some get to zero earlier, some get to zero later, some are more negative in the end of the century than others, and so on. But really, this is a quite narrow path, a 50% reduction in emissions by 2030, the next decade, net zero sometime around 2050, and also on top of that, we need rapid reductions in non-CO2. Although, as I was indicating before, if we miss out on the 1.5 degrees, we don't get down quite fast enough, then rule of thumb, if you get to net zero in about 2075, that'll be about 1.75 degrees of warming. Net zero at the end of the century, that's about 2 degrees of warming. So there's this sort of sliding scale, if you like. The earlier you get to net zero, all else equal, the lower the temperature will be. This is a stylized figure, essentially taking, if you like, one of those scenarios from the previous figure and splitting it into emissions and removals. So the previous figure is actually showing net emissions. So we have some positive emissions and we have some removals, things like growing forests or a machine which takes carbon out of the air. And one thing that's very important is that even when you have very large removals, as in this figure here, the emission reductions are still gigantic. They're still huge. So extreme removals, and I say, large scale removals, the green area here, to get that scale in terms of removals, you're talking about forests or bioenergy plantations several times the size of India, give or take. That just gives you an idea of the immense scale. So even if you do that, you need massive reductions in emissions. Now, we often hear about a sea of acronyms. They're at least a sea of acronyms to me. All these, hopefully everyone knows what these acronyms mean. There'll be a quiz at the end. But even if your companies are trying or institutions are trying to be part of these sort of initiatives, but unless their emissions are going down, it is not really helping much. And to give you an example of that, this is what many people envisage net zero to look like. And it's not possible to solve the climate problem using removals, but continuing to have emissions. So they're in the climate community now. There's a few people that are starting to become a little bit critical of the concept of net zero, not the physics, but the concept, because many people put a little bit too much emphasis on the net and not on the zero part. So you can't sort of offset or remove your way out of this problem. We have to remember this is a transition to get to 1.5 degrees. Let's say it's a transition to zero in 2050. If you're a company, for example, today you're embedded in a fossil economy. So even if that economy is transitioning, you can't get to zero today without using removal. So you have to keep in mind that those removals might become important later after you've reduced your emissions a lot. But in the meantime, you can't just simply decarbonize when you're in an economy which is based on carbon, at least fully. And this indicates that everyone must act together. The IEA, International Energy Agency, they also have a net zero scenario. And I would say this scenario or this report that they write provides very good detail on what needs to happen. As you saw earlier, there are many pathways that could get you to 1.5 degrees. There's no unique solution. There's no silver bullets. As you see in this figure, there's lots of pieces of the puzzle that fit together. And the IEA shows, in a sense, one way of fitting that puzzle together. But they have very nice, crisp outcomes. For example, there is no need for new oil and gas. But we also have to remember that this isn't a purely supply-driven exercise. To get into a situation where you need no new oil and gas, you also need to have policies on the demand side which are pushing down demand. So essentially what happens in the scenario where the demand side policies push down the demand for oil and gas, and if you do that, voila, you don't need new oil and gas facilities. So it's not a supply-driven exercise, which many people tend to confuse. But the most important thing here to highlight is there's a transition, there's an interplay. Everyone needs to act on the supply side, demand side to get emissions down in a sufficiently fast way. And just to finish off and to remember, we're often now mentioning all these acronyms and there's complexities, emissions and removals and scenarios all over the place, and it starts to get overly complex. But really, we have to remember that it's quite simple. What we're trying to do here is to stop burning fossil fuels and stop cutting down forests. And essentially, we solve the climate problem when we stop burning fossil fuels. Of course, in practice, it's much harder than that. But we just, I think, often have to come back and remember about the simplicity of what we're trying to do. And I'll finish up there. Thank you.
Thank you, Glenn. Those key messages from the latest climate science inform all of our work on the Shades of Green side, particularly the evolving concept of what it means to be truly best practice. I'm Catherine Rothaker, and I'm an analyst on the CICERO Shades of Green team. As Krista mentioned, I had the pleasure of coordinating the best practices report development process this year, drawing on the talents and insights of our broader team. By reflecting on our work each year, we aim to provide a valuable resource for the sustainable financing market. Before we dive into specific instruments and sectors, I'd like to provide an orientation to the broader report. The report, as you can see here, is broken down into 3 main sections. The first is a year in review, providing updates on our team and market position, as Krista shared, the latest climate science that you heard from Glenn, and key sustainable finance market developments that I'll touch on later. In the second section, we provide an overview of our award-winning Shades of Green methodology and product and service offerings. And in the final section, we highlight sector-specific best practices and case examples from the past year. Our Shades of Green methodology that you'll see on the next slide is likely familiar to many of you. The shades reflect the extent to which investments and operations contribute to the transition to a low-carbon, climate-resilient future, as well as their exposure to climate risks. This allows us to take a long-term, nuanced view, but provide insights in a clear and comprehensible way. In terms of our products and services, on the next slide, you'll see that our offerings fall into 2 main categories. First, we provide second-party opinions on green and sustainability financing frameworks. This category includes annual green bond impact and allocation reporting reviews. And second, we also offer company assessments, including for the NASDAQ Green Equity Designation and Green Initial Public Offering Risk Assessments. Woven throughout the report, you'll find connections to the 5 sustainable finance market developments on the next slide that we've highlighted in the year in review section. This includes the growth we've seen in green taxonomies globally. In at least 24 jurisdictions, they've already introduced or are developing or considering these classification systems. While these efforts can provide clarity and standardization in green financial markets, they also have the potential for controversy or confusion. Karina will share more about our EU Taxonomy assessment approach shortly. Another theme is greater interest in impact reporting. As green financing markets mature and investors seek to understand the actual environmental outcomes of uses of proceeds, our annual reporting reviews can help assess how relevant and transparent an issuer's reporting back to investors is. A third trend you'll see throughout the report is the rise of sustainability-linked financing. Sustainability-linked bonds, or SLBs, have grown to nearly $119 billion in 2021, a tenfold increase from 2020. Keith will share more about how we approach SLB second-party opinions. Fourth, companies are increasingly making net zero target announcements. In many of our products, we help investors understand how meaningful these commitments are, how they relate to climate science, and how they compare to peers' goals. Finally, companies are also taking a greater interest in how their suppliers are managing emissions. While in many sectors, these Scope 3 emissions can be the largest share of companies' footprints, they can be challenging to accurately measure or estimate. We take a value chain approach and encourage issuers to use their influence to address this challenge. You can see from this range of topics covered in the report the breadth and depth of expertise across our team. With that, I will let you hear from some of them directly and turn to Karina to discuss EU taxonomy developments. Thank you.
Thank you, Catherine. Over the last year, we have done EU taxonomy alignment assessments for green finance frameworks and companies within the sectors of real estate, energy, banking, transportation, and manufacturing. We welcome that the taxonomy creates a common language for assessing and defining what is green, while we also see that it does not always represent best practice, and that the detailed approach sometimes misses important elements. Next slide, please. A taxonomy assessment is an optional add-on in our second opinions and an integral part of our company assessment, where we provide transparency on likely alignment with the relevant criteria for each activity for the three elements of the taxonomy. That is the environmental thresholds, they do no significant harm to the other sustainability objectives, as well as the minimum social safeguards. And in our assessment, we highlight any gaps to these criteria to facilitate companies' reporting and to point to areas where they can improve. We do consider the company context when doing an assessment, and we give more emphasis to areas where we see the highest risks. On the minimum social safeguards, we focus on human and labor rights. So on a general note, we often see gaps to the DNSH for climate change adaptation and the transition to a circular economy. We are encouraged to see that the taxonomy seems to contribute to place different environmental objectives higher on the agenda, and to see that companies are making additional efforts, in particularly in the field of climate change adaptation and resilience. So I would now like to briefly go through one example. So we assessed Swedish real estate developer Diös green bond framework against the EU taxonomy thresholds. The framework was structured around the activities in the construction and real estate category, but it combined the taxonomy thresholds with additional criteria, such as green building certifications and more ambitious energy performance requirements. We assess that all activities are likely aligned with the mitigation and DNSH criteria, while noting that there was some missing information in relation to the transition to circular economy. One question was raised prior to this webinar on how to align to the taxonomy if a national definition of the nearly zero energy building is missing, which is relevant for new construction. And on a general note, we use the current regulation as a proxy, but this needs to be assessed on a case-by-case basis. On the minimum social safeguards, we considered Diös to mainly fulfill these, while we noted a potential weakness due to the absence of a mapping of human rights risks. And with that, I would like to hand over to my colleague, Christina, who will talk about our company assessments.
Thanks, Karina, and good morning, everyone. I'm going to present some best practices from our company assessments. But first, on the first slide here, I would like to give an overview of the company assessments. Sorry, Gracie, next slide, please. Thanks. So our company assessments, for those who are not so familiar, are a practically unique tool to understand the climate risk of a company. And they're used by companies large and small, for example, in preparation for a green IPO, or for listing for companies listed on NASDAQ to apply for the NASDAQ Green Equity designation, where we're one of the reviewers, or to provide investors with additional transparency. So there's 3 elements to our company assessments. And the first is that we assign a shade of green, yellow, or red to the revenue generating activities, the operating costs, and the investments of the company. And this gives investors a really simple and unique way of understanding how the company's actual activities are aligned with a low carbon future. And the investments also give a view to where the company is heading. In addition, we assess companies' governance structure, and we also assess the likely alignment with EU Taxonomy, as Karina mentioned. On the next slide here, you see some best practices that we've seen in the last year of assessing companies. The first one here will not be a surprise to anyone. We have seen that a lot of companies have recently created emission reduction targets that are aligned with the Paris Agreement. So you're soon going to hear from my colleague Keith Lee, and he's going to discuss SLBs and targets in more detail. So for now, I'll say that what we see as a best practice here is that in addition to having a long-term, say 2050 target, that you follow that up with medium-term and short-term targets, and also that you have a clear strategy for how you're going to reach these emission reduction targets. And of course, the second best practice that we see, this follows that, is that you actually embed these climate targets into the corporate governance structure, and particularly corporate decision making. And what we see as really like best practice among the best practice is to have it embedded into the corporate financing decisions in different ways. The third best practice that we'd like to highlight is to have a due diligence process that covers both environmental and social risks. So the minimum social safeguards that Karina mentioned in the taxonomy, that is an area where we are still seeing quite a few gaps from companies just on understanding and fully managing social risks. But because of the increased focus that we see in this area, this is something that today is best practice, but that I think that in a couple of years will be market practice. So something to look out for and really to focus on. The last 2 best practices here are related to transparency. So the first is that we are seeing that leading companies are starting to integrate financial and environmental accounting and reporting. So this can be done in a couple of ways. For example, we see that there's some movement to integrate emissions and emission accounting systems with regular accounting, financial accounting systems, or by including, for example, the revenue shading and the financial shading that we provide through CICERO Shades of Green in the annual report. So there's different ways of doing this. And then in addition, the last transparency point here is to have targets and metrics that allow investors to track progress over time, and especially for those companies that are in a transition phase. So this could be done with different clear metrics or targets, or it could also be done, for example, by annually updating the company assessment and providing that to investors. I'd like to end on an example here, which is a green IPO that we worked with for the company Rebelle. So this was a really exciting case for us to work with. They are a re-commerce company. So they have a digital platform facilitating a secondhand market for luxury fashion. And 100% of their revenue, operating costs, and investments were related to this and were shaded medium green. Because the reuse of textiles is a really important step towards the circular economy. So Rebelle, they were the first company that actually IPO'd and received the NASDAQ Green Equity designation on the first day of trading. So the first green IPO on NASDAQ, but they join a group of companies, both large and small, that have received the NASDAQ Green Equity designation. Among the latest of those is Castellum, which is one of the largest real estate companies in Sweden. And we at CICERO Green have been fortunate enough to so far have worked with all of the companies that have listed with the NASDAQ Green Equity designation. There's a lot more to say on this subject, but I'm going to hand it over now to my colleague, Dr. Keith Lee, to discuss SLBs. Thanks so much.
Thanks so much, Christina. And if we just go straight to the next slide, I'll also talk a little bit about our approach to SLBs. And they have three main components, and one of which is similar to the company assessments, the application of our Shades of Green methodology to companies' revenues and planned investments. We also have that assessment of the company's environmental and climate governance. And then thirdly, in line with assessing alignment with the sustainability-linked bond principles, we are also assessing the materiality of the KPIs that have been included in the linked framework and also the targets. And then we also go a bit further beyond the recommendations of the principles in terms of digging into the issuer's strategy to achieve those targets, particularly thinking with the lens of our approach to assessing climate risks and benefits. Now, the reason why we include the revenue and CapEx shading is precisely because sustainability-linked instruments don't have a use of proceeds component. And so we think it's important to provide additional transparency and context to the issuer for investors beyond what is represented through the KPIs and the sustainability performance targets. If we go to the next slide, please. So in terms of best practices, I think those of you who are familiar with the sustainability-linked bond principles will have seen some of these before, but I think it's really important to emphasize the materiality of the KPIs. Firstly, in terms of covering the issues, the issuer's most material environmental issues, and thinking about that from a double materiality perspective. So not only thinking about the risks, but also the issuer's impacts. And then also thinking about materiality from the perspective of coverage. So with that second bullet there, having KPIs cover meaningful share of environmental impact. And of course, this applies collectively. So we expect that KPIs can collectively represent or address material impacts and risks. Thirdly, for emissions reductions targets, we do believe it is very important to represent them and report on them in terms of absolute emissions as well as emissions intensity. And the reason for this is that neither shows the entire story of the issuer with respect to emissions reductions. Indeed, because of external factors, you can have absolute emissions declining without any improvements to carbon intensity or carbon efficiency. And on the flip side, you can also have emissions and intensity decline while absolute emissions stay the same or worse, continue to go up. So we do think it's important to have both of those represented. Fourthly, ensuring targets are methodologically sound and scientifically meaningful. So, as Christina mentioned, for emissions reductions targets, the scientifically meaningful aspect is really that alignment with the Paris Agreement, the inclusion of the short and medium term targets. Think back to that graph that Glenn showed you earlier in terms of the importance of immediate cuts that we need. But then also on methodology, certainly methodological rigor in setting targets is important, but also for the KPI calculation methodology itself, we do seek to understand, there needs to be transparency around the assumptions, what is the data used, and basically to make sure that the KPI, achieving the KPI and the targets does not contribute to outcomes which are not intended. Fifthly, providing transparency on the issuer's strategy to achieve the targets. Again, this is really important to help investors understand exactly what the company intends to do. And ideally, we would see the issuer publish all the initiatives and investments that it intends to make to achieve those targets, and have those organized to show the trajectory by which it goes from status quo to achieving those targets. And lastly, we do want the sustainability-linked framework to represent a shift in the status quo of the issuer with respect to its activities and its overall business strategy. So we do expect, again, that transparency on exactly what needs to change in order to achieve the SBTs and contribute to a low carbon future. Next slide, please. So just to end with an example of Hydro, which is a vertically integrated aluminium producer based here in Norway. They published a sustainability-linked framework earlier this year alongside a green use of proceeds framework. And we're very pleased to work with them on that. They received the governance score of excellent on account of the comprehensiveness of their climate and environmental strategy and targets, but also the kinds of safeguards that they had in place with respect to biodiversity loss, water, and so on. In terms of the revenue and capex shading, you'll see that we shaded about 40% of their revenue, some shade of green, and 61% of their planned capex as some shade of green as well. And those shadings primarily pertained to aluminium that's being produced in line with the EU Taxonomy thresholds for aluminium production, and also the production of secondary aluminium. And the capex similarly was associated with investments in facilities for the production of the EU Taxonomy aligned aluminium and also secondary aluminium. Now they had two targets. One was to reduce scope 1 and 2 emissions, and the second one was to increase the post-consumer scrap aluminium recycling capacity that they had. Now the second target was included as a proxy for their scope 3 emissions, as the company is still working on setting a scope 3 target. And as a result of that, collectively we were able to assess them as material to the company's climate risks and impacts. And in assessing those targets, we found that both of them were ambitious against both the Paris Agreement, also their immediate peers, and also their own past performance. Maybe a quick note on the benchmarking against the Paris Agreement that we did. This was done in reference to the International Aluminium Institute's pathways that the company itself referenced, but we also referenced pathways and analysis provided by the International Energy Agency and also the One Earth climate model. Now you'll see that we included some caveats pertaining to natural gas lock-in. And the reason for that is, it kind of links back to our qualitative shades of green approach as well, in terms of identifying Hydro's intention to use a natural gas investment as part of the emissions reduction strategy. Now they have plans to eventually phase out the use of natural gas, but because of our focus on emissions lock-in, that was something that we felt we had to flag as a risk for potential investors. But overall, again, it was a very positive and we felt it was an ambitious framework, and we're very pleased to have worked on this with Hydro. So with that, I'll hand over to Tim, who will talk to you about energy.
Yes, thank you very much, Keith. Going to the business end of the presentation, so it's a very good time to inject some energy, if you will. So let's have a look at the best practices, or what we consider to be the best practices in this sector. I think initially it's important to say that for the next few slides, my approach is going to be to focus on what we could describe as more general or generic best practices in the energy sector. That is those that can apply across the subsectors, rather than looking at subsector specific considerations, for example, in respect of bioenergy or offshore wind. Though that being said, we will spend a little bit of time in the last slide looking at nuclear energy. What I've done therefore is I've set out three high-level general best practices for the sector. The first is sufficient stakeholder engagement and seeking to ensure local support for your project. We know that there's often opposition to all types of energy projects. And so early, collaborative and good faith engagement with a broad range of stakeholders is very important to reduce the risk that these can cause to the project. Secondly, consideration of biodiversity and ecosystems, risks and impacts. The production of climate-friendly energy is not in itself best practice. That requires consideration of biodiversity and ecosystem risks and impacts. That starts with project selection, where you're going to be doing your project, but also should apply throughout the whole lifetime of the project as well. Finally, risks and emissions in the supply chain. We know that even renewable energy projects can have substantial life cycle emissions, and that all types of energy projects can have risks arising, climate and environmental risks arising in the supply chain. Identification, mitigation, and actions on such emissions and risks is therefore considered best practice. A good example of this, if we move on to the next slide, was Statkraft, for whom we provided an SPO around Easter time this year. Statkraft are a Norwegian state-owned energy company and Europe's largest generator of renewable energy. Their framework focused predominantly on hydropower, solar and wind, and was assigned a dark green shading. We were also able to award them an excellent governance score, And one of the reasons for this was that they have started to include environmental requirements in supply and construction contracts. For example, the use of recycled steel or the use of concrete with reduced emissions. Given Starcraft's investment plans over the next decade, which amount to many billions of euros, this can have a substantial impact on the emissions associated with its framework, and was a very impressive aspect of that. Looking finally at the nuclear energy sector, CICERO Estate Green, we're the first SPO provider to provide a green label for a framework that contained nuclear energy. And our most recent example was for EDF, who are the French state-owned multinational electric utility company, whose framework sought to finance renewable energy projects, including nuclear projects. It goes without saying that nuclear is a controversial energy source, both in Europe and globally. But the fact that it is climate friendly cannot be denied, and the emphasis that's placed on nuclear in many climate scenarios and climate projections to allow us to achieve our warming targets is also important to note. Of course, nuclear energy production does come with large risks related particularly to final waste disposal. What are we going to do with the waste? Maximum credible accidental radiation, and also ESG risks in the supply chain linked particularly to the mining of uranium. Those risks can be both environmental and social. We were able to award EDF an excellent governance score, and one aspect of this was its impressive policies and actions in respect of these ESG risks related to the mining of uranium. And its ability to work with those risks, to acknowledge those risks and mitigate them, also allowed us to award a medium green to the framework overall. And we are very grateful to work with both Starcraft and EDF, who really are pushing the boundaries in their respective fields. That's it for the energy sector. Thanks a lot, and I'll pass on to Maria.
Thank you, Tim. So to finish off, we will talk about the real estate sector. And this is a sector where we have done quite a bit of SPOs and also company assessments, and especially then in the Nordic context. And if we look at the 2050 perspective, we will still need buildings. We will still need places to stay, for example. But we do see that there are some challenges within this sector, and especially linked to the emissions associated with real estate. Because if we, for example, looked at energy use, then 40% of all emissions linked to energy use comes from the real estate sector. And if we look at, for example, building a new building, then you need materials. And the manufacturing of key materials is linked to 11% of global emissions. So it is clear that this is one of those sectors that needs to transition to more low carbon methods. So if we go to the next slide, I have taken the same approach as Tim. So I will talk about 3 kind of key considerations that has to be taken within real estate. So first, we can talk about energy use. And the good news with the energy use is that the methods and the data about how to reduce energy consumption in buildings are already there. And this is something that has been focused on for quite some years. And then when we are looking at the issuers, we see that they often, especially for new construction, have quite ambitious targets. What is important to remember is that from a 2050 perspective, that 80% of the buildings we will have then are already constructed today. So therefore, it is important to invest in the existing building stock and do those classic measures such as adding isolation to walls, changing out windows, and also upgrading technical systems. The second consideration I'm going to talk about is these emissions linked to the materials when you're constructing, because this is linked to embodied emissions within real estate. And embodied emissions is just emissions that are not linked to the energy use. And the challenge here is this is something that hasn't been talked about as much as energy. And therefore the methodologies and data isn't as strong. So it's more challenging to reduce embodied emissions with buildings. The positives are that we see that, for example, the Nordic countries are trying to shift the focus a bit with also looking at embodied emissions. So they are, for example, making it mandatory to calculate the global warming potential of a building when you're constructing it. And this has already been done in Sweden. And we're also seeing that we're trying to set limit values of what this value could be. We're also seeing that the issuers are focusing more on embodied emissions, and often they're trying to set a strategy to reduce these emissions, and are also often working together with municipalities, other companies, and organizations to try and gather more knowledge about the subject. The one thing we do know is that within a project within real estate, the easiest way to decrease embodied emissions is to try and not build a new building, but look at the existing building stock. Are there already buildings that are there that can be renovated or adapted for the use you have in mind? The third consideration is linked to physical climate risks, because buildings are all over the world and all regions are also exposed to climate change. And we see that this can mean more extreme weather, more strong winds, more heavy rain or heat stress. And this can cause a lot of damage on buildings. So therefore, best practice is to see which areas are you working in, see how might the climate change in these areas, and see what type of action should be put in place to mitigate against these risks. So these are kind of three key considerations we see that should be made with real estate. And a lot of companies, to kind of address these, use environmental certifications. And these certification comes with a lot of positives. It's, for example, BREEAM or LEED, but we do see it as a challenge that often they vary quite a bit in their consistency and what they actually assess. We see that they're often stronger at looking at energy use, but might not look as much at embodied emissions and climate risks. So this can be a challenge. However, we do also see that these certification wants to stay relevant, and therefore when they're updating their manuals, they do try and look more on these themes as well. So to finish off, we're going to look at an example, which we have chosen HDR Property Partners. So they work in Finland, are a Finnish real estate developer and investor. And Finland is one of these Nordic countries that are looking to set limit values for global warming potential of a building, and also then the embodied emissions. And when they're in this work, they have ordered a report to look at what could this limit value be. And what HDR did in their framework was that they referenced to this report and said, we have set a limit value that is 10% more ambitious than what the authorities are looking at. And what was very interesting here is this was one of the first time one of the times where we've seen that embodied emissions has also been included as a quantified target in the framework. And overall, HDR Property Partners assigned a medium green and awarded a governance score of good. So with that, I will hand the word over to Krista again.
Thanks, Maria, and thanks to all our presenters today. We have a number of other sectors covered in the report. There were some questions submitted ahead of time asking about mining and aquaculture. Those are covered in the report, so we encourage you to take a look. We did not have time to present everything in the report today, although I'm grateful that all of the presenters managed to keep even ahead of schedule. So I wanted to encourage you again, reach out with any follow-up questions. You can download the report on the website you see on the screen, or reach us at the info@cicero.green email. And we'll follow up by sending you a link to the recording of the presentation, the report, and the presentations from today. Thank you all for joining us, and we'll give you the gift of 10 extra minutes in your day today. Thank you. Bye-bye.